Considerations for transactions involving a growing company. So there are some situations when a company is looking to sell or exit or secure capital where performance has been generally consistent. You can think of the widget manufacturer, distributor, or software company that's generally produced the same amount of EBITDA for the last 10 years. And those are excellent scenarios. However, there's just as often the scenario that the company is growing. And oftentimes in the size range that we work within, typically $400,000 to $4 million of EBITDA or pre-tax earnings, this growth can be substantial. You can have companies that are growing at 50, 60, 100% per year. And so when you look at the regression line, if you will, of the trajectory of the business, there's meaningful growth. And so to some extent, the historical view towards that in private equity, and this is going back decades, was, hey, let's take an average of the last 3 years and use that as kind of our valuation, if you will, for either an infusion of capital or for an acquisition of business. However, at the size and complexion of the businesses that we work with, doing so, particularly in a high growth scenario, can really impair the value of the business. And so it's very important to put the narrative forward as to why this is not just growth that needs to be averaged, but the new normal of how the business is going to function, and providing even further substantiation for further growth. So I wanted to talk about a few considerations, a few elements of the narrative that helps support the optimal valuation in these higher growth scenarios. So first is, what is the cause of the growth? Is it the fundamental growing of the business? Is it a one-time wacky event, or is it something that's going to be consistent and evergreen, if you will, throughout the further growth of the company? The more you can substantiate that, the more you can again lean towards the more recent numbers as the metric of valuation. The second, and kind of building off of this concept, is the permanence of this change or growth. And so if a company had 2 salespeople and now it has 5 salespeople and revenue has grown 2-3x, you can make the case that the beefing up of the sales force was the catalyzing factor towards the revenue, and therefore if the staff stays the same, there's no reason why that revenue should go backwards. And there's obviously a lot of other variables in a business to consider similarly, but that's the idea, is what was the cause of the growth, and why is it permanent? Why is it sticky? Why is it likely to continue? And how high of a probability is there? And optimally, you want to prove that there's 100% probability. Next is the further progress or further growth potential for the business. And so if you say, okay, here's the cause of growth, here's why it's sticky and permanent, and here is the future opportunity set for the business as to why this growth is going to continue, it just further helps solidify the case as to the optimal value and structure for a business. I'd say lastly is the operating leverage or the operating infrastructure for the business. And so again, rehashing all of these yet again, if you have the cause of the growth, why it's permanent or sticky, what the future growth is, and why the infrastructure of the company or the operating expenses of the business can support that growth, well, now the narrative is really tied together entirely. And so the goal of this is, as we're presenting an opportunity to the market, and whether that be for an exit or a sale or for capital, you want to really make the case as to why the most forward-looking financial performance of the company should be the underlying multiplier, if you will, for the valuation, whether in an exit or the implied valuation relative to a financing or capital infusion in a business. If we can move that conversation away from an average of the last 2 or 3 years into either the current year, or in many situations the year-to-date performance plus the projections towards the end, and in some situations even the forward-looking 12 months for a business, but the more you can make the case based on these variables, the higher the probability that you're going to be able to substantiate one of these more forward-looking financial metrics, and again, therefrom imply a higher valuation in an exit or a higher implied value for financing. And so when you think of financing, oftentimes the amount of capital that will be provided is a multiple of EBITDA, and therefore the higher that EBITDA multiple, by looking at, again, trailing 12 months is often the metric, as opposed to an average of the last 2 or 3 years, then the amount of available financing will be that much higher. And so that's the thought for today. Growing companies are exceptional situations and only provide tailwinds for the conversations. However, it's vital that the narrative is communicated the proper way to take the optimal metrics from which to calculate that valuation or financing capacity. Hope everyone's week continues to go well. Keep pushing forward. God bless. See everyone next time.